Just wanted to share some information on a property we'd located for a client that actually has quite a strong cash flow attached to it. Based on the numbers on that particular property, without the client actually making any additional contributions into their home loan, the cash flow off that would be able to pay off their home loan about 12 years early. So I just want to step you through some of the factors that have actually assisted in building that cash flow into the property, and show you some of the numbers on that. So a key factor in looking at that property and its location was actually looking at the vacancy rate. So you can see here the vacancy rate's quite low. So just to sort of put that in perspective, normally around equilibrium in the market is around about 3%, which means roughly there's about the same amount of people looking for property to rent as there is actually properties available. At the moment in this particular location, the vacancy rate was down to 1% and actually has been in decline. So it's actually quite a tight market. So in those sort of conditions, what you're going to find is properties rent quite quickly, but also there's factors there that could potentially drive the rental growth along as well. So you know, in terms of us looking at locations, that's a pretty important factor in there. So some of the other factors in relation to this property is that actually drove its cash flow. It actually has quite a high yield attached to it. In fact, fairly above market for the yield there. But it also had a very strong pre-tax cash flow. So what that means is after all the expenses on the property, so that's covering all the operational costs of the property, plus actually carrying the covering the finance costs as well, that property was actually returning a positive cash flow. So in essence, it was actually making a profit. The thing, however, is the other factor in that property is it actually had a high level of depreciation. So without getting into too much detail, basically that depreciation meant that we could actually then offset the pre-tax profit that property was making. So on paper, from the ATO's point of view, we'd be making a loss, even though it's actually generating a fairly substantial profit. So what that meant at the end of the day is after all the expenses were covered on that property, the client would actually receive $9,900 tax-free after they've met all the expenses on that property. So that's extra money then that they can actually channel into their home loan, in addition to what other payments they're going to make to help pay off that loan faster. So, you know, their loan was roughly sitting at about 451. We're in the process of negotiating the rates, but the rate's around about 2.84 at the moment. Might be going to be a little bit better than that. But what that meant was there's an extra $190 a week that they could channel into that home loan, which would then cut around about 12 years off that. So based on that property, plus actually doing some other changes with their budget as well, they're actually on track to actually pay off that loan a lot sooner. It's probably going to get closer to around about 10 years by the time we finish that structure on that property. Aside from the cash flow on that property, the other thing we really liked and something that we look for, particularly for clients that are in a position to do it, is the location was actually what we call an infill site. So what that means is it's actually a little development or small development, small subdivision in an already established area. So it's a built up area. It's already got the infrastructure. It's got schools, shops, hospitals, you know, all the transport infrastructure, etc. So it's not what we'd call, as opposed to what we'd call a greenfield estate, where a lot of that stuff's to come. So you're actually buying into an established area, which is great, but you're actually getting a lot of the benefits that come with a new property. The other factor in there in that location is it's also had a pretty solid growth track record over time. So not only were they getting into a well-established area with good fundamentals, but there's also a good growth track record there as well. And they're also getting high yields. So really ticking a lot of the boxes that we'd look for a client as well. So not just the cash flow coming in to help pay down their home loan, but longer term, you know, likely to be a pretty good growth asset as well. Anyway, so I hope you found that information interesting. I'm going to keep trying to post and share information about property finance, etc., and the stuff that we're doing with clients as well. If you like the information on this video, then hit the like button below, and actually click on subscribe, so that'll make sure you get information into your inbox. And also, if you want to have a chat about your situation, whether it's trying to look at strategies to pay off your home quicker, or you're interested also in talking about strategies around how you can use property investment to do that, then at the bottom of the video here, and also on the email, there's a link where you can actually book in just an obligation-free chat. Anyway, I hope you have a great day. Thanks.